Thanks for joining us today on Morning Markets. I'm Morella Fernandez. Let's get to the stories we're following in the BNN Bloomberg newsroom. South Korea looking to triple its crude oil imports from Canada to 16 million barrels. An official visited this country this week to discuss ways the countries could expand their partnership on energy supply chains. The increase in imports could grow to 20 million barrels in the coming years. South Korea imports about 70% of its oil shipments via the Strait of Hormuz. The U.S. proposing tariffs of 10% or more on products from trading partners they suspect were made with forced labor. Canada, Mexico, Taiwan, and the UK will face the additional tax for failing to enforce a forced labor import ban. That's from the report. The new tariffs won't take effect until public hearings take place. The price of canola has hit its highest level since September of 2023 on expectations of lower production in Australia. Growers in the country have been struggling with high fuel and fertilizer costs due to the war in Iran, as well as drier weather. The decline expected to tighten global supplies. Australia is the world's second largest canola exporter after Canada. Let's have a look at where we are on the markets right now after a record close yesterday. The TSX Composite 81 points down today at 35.98. South of the border, markets are down as well. The S&P down 0.4% or about 30 points. The Dow Jones down over 375.7%. And the Nasdaq down just over half a percent, 144 points down so far on the day. So North American markets, as you saw, under pressure as the shaky ceasefire between Iran and the U.S. drives the price of oil and bond yields higher. Let's talk about some of this with Dustin Reed. He's chief strategist of fixed income at Mackenzie Investments. Dustin, thanks for joining us.
Thanks very much for having me.
So you're looking at opportunities now in fixed income, and you say yields don't matter as much as entry point and duration. But can you explain?
Yeah, so I think that the fixed income market has a lot of interesting opportunities here at the moment. The things that we're looking at Mackenzie really center around the idea of maybe not investing as heavily in nominal duration and maybe looking a little bit more at what we would call globally linkers or inflation-protected securities, real return bonds in Canada or TIPS in the U.S., but we're getting real returns from the fixed income market because we do believe that the higher for longer story on the energy side is going to be with us for a bit. And that's going to be not only oil, but the whole complex. And that leads to higher inflation, and that leads to a higher term structure of interest rates. So, the biggest enemy for fixed income investors, of course, is inflation. And so we're trying to provide a good return, maybe even a better than good return for our investors within the fixed income space, within what we think is a persistently high inflationary environment.
Okay, you mentioned that you think that the higher price of energy will stick around for a while. When you are making your calculations, how long are you factoring it to be?
So right now I'm thinking months into the summer. Obviously we think longer term than that from a cyclical perspective, maybe 3 months 3 to 6 months or even longer, but obviously the news coming out of the Middle East is challenging to follow in a way, a lot of it kind of up and down and not necessarily with a lot of momentum. I think stepping back, what is happening here, I think the strait's going to not be, whether it's open or closed, it matters, but doesn't totally matter. Volumes are not going to come back to where they were pre-crisis anytime soon. And infrastructure has issues, and boats and ships getting back into the strait. It's not just about ships leaving the strait, but about boats and ships coming back into the strait are not happening anytime soon. So that supply deficit is going to be with us for a bit. And countries are going to want to increase their, replenish really their SPRs, all the oil that they've drawn down over the last number of weeks to obviously kind of fill the gap. And so there's going to be demand and pressure there. So the back end of this year in terms of where energy is priced, particularly oil, I think, and for most consumers and what people are looking at, Oil prices for the back end of this year probably still need to come higher. So there's definitely a deficit in terms of, or at least a mismatch between supply and demand. And we think that keeps an upside risk to inflation going forward and has implications, obviously, not only for fixed income, but for all asset classes.
So, Dustin, we've been talking about the price of gas, people paying more when they try to fill up. Are you seeing corresponding price changes in the transportation sectors or other energy-reliant industries at this point?
Yeah, absolutely. I think we're seeing transportation costs move higher, for goods, across North America and around the world. We've seen some comments both from actual industrial companies as well as shipping companies saying we need to increase prices. So I think that those costs are going to be with us for a bit, and they'll get embedded. I think, as is often the question, where in the supply chain is that going to be most affected? Is that the manufacturer level, the importer level, distribution level, the retailer level, the consumer level? And in reality, it's probably going to be some part of all of that. But obviously, as we sit here for markets, and back to your question, it's about the consumer side and what consumers end up paying. And we do think that consumers are going to end up paying a little bit more for a little bit longer, unfortunately, which, obviously puts a squeeze on, a lot of consumers in North America, and I would say particularly in Canada, given, our more cyclical economy versus the U.S.
Let's talk about Bank of Canada. What do you expect for the next meeting? What do you expect for the rest of the year?
Yeah, so the bank's in a tough spot, as are most central banks at this point. At the Bank of Canada meeting that's coming up this month, I think we will not see a rate move in either direction, and I think that there's discussion maybe about both sides. The market is pricing really nothing for this month, and I think pricing around 25 or 30 basis points for the rest of the year in terms of hikes. We've had a view for a while that the Bank of Canada could actually cut rates in 2026, which is a bit of a non-consensus outsized view. And we still retain that, although the further we get into the year, obviously, the less that might look a little bit likely. And other central banks are obviously looking at hiking, including maybe the Fed in the U.S. But we think the domestic economy here is quite weak. That's been our view since 2025. And the Q1 GDP numbers coming out of Canada would clearly show that. We think there's a lot of risk around USMCA. Again, that's been a view we've had since 2025. And I would say the headlines over the last week or two seem to suggest that is becoming more of a risk. The housing market continues to be a bit of an issue here, I would say, going forward. And population growth, and we even had we have Prime Minister Carney living in a former era. We have Prime Minister Carney even talking about the declining population growth in the country being an economic headwind. And that's true. It's very difficult to have trend or above trend economic growth for a prolonged period of time when you have falling population growth, which we did in Q3 and Q4 of 25, and we probably will continue to in 2026. So I think there's a lot of headwinds here in Canada, and I still think that the Bank of Canada's rate should be below its neutral, the bottom end of neutral at 2.25, and it should be closer to 2% or even below 2%.
Okay, I'm just wondering if you can do a quick comparison with the U.S., how you see that situation different from ours. Obviously, their labor market is different, their growth perspective is different.
Yeah, absolutely. I mean, we'll get both jobs data obviously this Friday with NFP and LFS in the U.S. and Canada. We had the JOLTS data in the U.S. earlier this week, which is a month delayed, so it's April data, but pretty hot. The narrative 6 months ago was, we're concerned about AI and job losses, and that kind of changed pretty quickly to losses to stabilization. And I would say, let's see what we get on Friday with NFP, but the JOLTS data for April, really kind of changed that narrative, I would say, a bit in terms of less around stabilization and more around, here we go, upside again in the U.S. I think the labor market looks pretty constructive in the U.S. when you look at the hiring rate out of the JOLTS data. Obviously, the unemployment rate remains very, very strong. The AI story, I think it's important, but it's a bit more of a medium-term cyclical issue. It's not a short-term issue. I think we're seeing a lot of jobs being impacted in terms of we need more people to build out these data centers. Electricians, construction, raw materials, bid for commodities, all those things. So I think that's happening. There's a very big difference here, I think, right now at this point in the cycle between where the U.S. macroeconomic outlook is and where the Canadian macroeconomic outlook is. Obviously, economics, there's not necessarily markets, and markets are not necessarily econ, but there is obviously some overlap. But there's a growing difference here, and I believe in the AI CapEx story in the US, and I think we're still in the middle innings of the AI CapEx build out, and it's going to continue to power the US economy going forward.
All right, I do have to leave it there. Dustin Reed, thanks for your time. Appreciate it. Toronto home sales just saw their biggest monthly increase in 10 months. More in a moment. Stay tuned. Toronto's housing market may be showing some signs of life. Home sales rose 10% in May from April, the biggest month-over-month gain since July of last year. The question now is whether this marks the start of a sustained recovery. We were joined by Jason Mercer, Chief Information Officer, Toronto Regional Real Estate Board.
If you think about our forecast at the beginning of the year, one of the things we were saying, it was going to be somewhat of a year or two has. We started obviously slow, but as some households in the GTA started to take advantage of the affordability gains that we've seen, both on the back of lower home prices and lower borrowing costs, we have seen more people move into the marketplace. And it's a good point you raised around the seasonality in the market. But even after you adjust for the time of year, seasonal adjustment, we're seeing sales rising over the last few months on a month-over-month basis. And we're also starting to see some support for pricing as well. And so that suggests that, tighter market conditions, a little less choice out there for buyers is starting to have an impact on pricing as well.
And is that it? So like it's just tighter? Is that it? Or people, what other reasons might be driving people right now?
Well, I think right now, you are seeing a little bit more activity in the marketplace from a sales perspective, and also listings have dropped off a little bit. And so those two together mean that we've absorbed some of the standing inventory that had really built up over the last couple of years. It's not to say that there's still not quite a bit of choice out there and that buyers are benefiting from that, but things have tightened up a little bit, especially in comparison to last year. But even what we saw, say, at the beginning of 2026 as well.
And has the market adjusted then to a more balanced approach when it comes to, we lost a lot of new Canadians, new immigrants coming in. Those numbers have dropped off. And they were coming to Toronto or Greater Toronto area. Has the region adjusted to that now too?
Yeah, I think the change in the temporary migration policy, really sort of impacted the rental market as well. Because, we were seeing very tight rental market conditions, say 2 and 3 years ago. We were seeing double-digit growth in rents, and now you're not seeing that as much. And on top of that, there's a lot of rental inventory as well. And that feeds through into the ownership side of things as well. Because if you have a renter household that was, thinking about purchasing a home, but they're on the sidelines, now they have more negotiating power on the rental side of things as well. And so I think that, as we move forward, we'll see more first-time buyers moving into the ownership market, but that push hasn't been quite as strong.
Okay, and where are there areas within the GTA that are hotter than others, or how's it working? Where are people looking?
Yeah, historically you've seen some neighborhoods are always tighter than others, even when you're in a bit more of a down market. So certainly those areas that are more focused on traditional single-family homes, where we're just not bringing on that type of stock any longer. You'll see tighter ownership market conditions, regardless of where you are in the cycle. Certainly, if you're looking at moving into the condominium apartment space as a first-time buyer, you're still benefiting from a lot of inventory, and so a lot of negotiating power is still there.
Yeah, I wanted to ask about the condo market. How's that doing? Is it enjoying part of that upswing as well?
Yeah, we have seen an uptick in sales, but at the same time, there's still a lot of standing inventory there. And so if you're, say, a renter right now looking at, what I'm paying for rent versus, what I'll pay for a mortgage, and obviously building equity in an investment over time, this is a better time now compared to, say, 2 or 3 years ago in terms of negotiating a good selling price.
So you're starting to see some of them move. And how about the rest? I know your focus is Toronto, but how does it compare to the rest of the country right now?
Yeah, and I think if you think of Canada, it's really a grouping of different regional economies, and so certainly some markets are going to perform better than others. But if you look at sort of the major centers, Toronto, Vancouver, for example, we've seen sort of similar patterns unfold where sales have been off just from an affordability standpoint, whereas inventory has been higher, and so So again, you're seeing buyers benefit from, a little bit more choice. But, things are changing a little bit gradually where we're seeing, slightly tighter market conditions, and that should provide some support for pricing initially, and potentially start to see some growth, especially as we move into 2027.
So how would you describe it? Buyer's market, balanced market?
I think right now the marketplace is still favoring buyers. You're still seeing enough inventory that they're able to negotiate on price in most neighborhoods and most segments. But we are starting to see things tighten up, and I think that'll even continue as we move into the second half of this year, especially if we start to see more certainty on the economic front, and whether we're talking about trade-related issues or whether we're talking about geopolitical issues as that relates to oil prices and inflation and what have you.
Jason Mercer, Chief Information Officer, Toronto Regional Real Estate Board. Algoma Steel in Sault Ste. Marie, Ontario, has laid off about 1,000 workers because of American tariffs on the metal. And now the community is looking for ways to fight back. CTV's Adrian Gobriel reports.
Along the shore of the St. Mary's River sits a northern Ontario city that's been propped up by the steel industry for more than a century. Though in recent months, the foundation of Sault Ste. Marie's economy has been forced to bend, though it hasn't broken just yet.
It's bent, and it's bent pretty sharply.
50% U.S. tariffs forced the city's largest employer, Algoma Steel, to accelerate their plans to pivot to electric steel making. In December, the company announced roughly 1,000 workers would lose their jobs, the largest layoff in Algoma's more than 125-year history. Here in Sault Ste. Marie, the local economy is already struggling. Here on this main strip, the theater's been boarded up, same with appliance stores and laundromats, and there's a fear that the layoffs at Algoma might make matters even worse.
The huge impact will be when EI starts running out.
Michael DePratt spent 56 years at Algoma Steel. He now represents more than 1,200 workers as union president. You believe diversifying from the U.S. is the only way forward for Algoma Steel?
We need to develop our own economy, right? We can't be vassals of the United States.
South Korean shipbuilder Hanwha has pledged to invest in Algoma and use the company's steel to manufacture new armored vehicles in Canada, if the bid is selected by Ottawa to deliver 12 new submarines for the Canadian Navy.
Frankly, we think that the bid that benefits our community is the bid that should be selected.
There are other potential bright spots in the Sioux's steel industry.
We're fighting back.
A joint $300 million public-private investment across town will see Tenaris expand its steel pipe production and add to its 800-person workforce. For Tenaris, it's all about doubling down on domestic production.
We are devoting more and more of our domestic production for Canada. So our exposure to the tariffs is going down to the extent that hopefully in a couple of months it will be going almost down to zero.
With steely determination, those who call Sault Ste. Marie home are pressing forward. The investments here at Tenaris will create 200 new jobs and hundreds of other spin-off positions over the next 3 years. Good news for a resilient steel city. Adrian Gobriel, CTV News, Sault Ste. Marie.
Coming up, today's market drivers with Bloomberg's Monique Mulima. Back in a moment. Time to have a look at the market movers today. Let's go to Bloomberg's equities reporter, Monique Mulima. She joins us now. Monique, Blackstone and KKR shares sliding today. More worries about private credit. Tell us about that.
Yes, so the private credit stocks are all lower this morning after Cliffwater reported that their flagship fund saw 17% redemption requests. This was higher than previously and higher than some people had been expecting, and that just continued to raise some concerns that we've seen in private credit this year, which kicked off after Blue Owl had started to see declines earlier this year. There's continued concerns about private credit's high exposure to software, which could be disrupted by AI, and also some of the other uncertainty in broader markets. And all of that is weighing on these shares, with analysts saying that if this doesn't start to improve, if the companies aren't starting to report lower redemptions, that it could take until Labor Day to see recovery. And if that isn't even improving further, it could take even till the end of the year until we start to see some momentum back in these stocks.
Okay, let's get to iron, which jumped on a price target raise. What triggered the upgrade?
Yes, so Iron, they are higher this morning after they announced that they got an agreement for an 800 megawatt data center in Australia. Analysts are really positive on this news. The company has been shifting from Bitcoin mining towards data center operating, and they see this being a big opportunity for the company going forward. They note that Australia is a market that has been less tapped for data centers. There's a lot of demand for power and not a lot of players in that market right now. So they see this is really positive that Iron is getting into that geographic area. And they also note that even though this data center isn't going to be up and running until 2028, it still adds a lot to Iron's pipeline and also shows that they can get these large-scale deals, which could then lead to them being able to secure more going forward.
Let's get to Kraft Heinz then. Well-known name, but it's going the other way. Did they get a downgrade?
Yes, so Kraft Heinz, they were downgraded this morning at Bernstein along with some other packaged food stocks. The analysts know that there's been some concern in this space, particularly with the rise of GLP-1 drug usage, as well as the Make America Healthy Again agenda as people are moving away from more processed foods. And the companies are also facing some margin pressure as rising energy prices have been raising their costs. So this is expected to potentially weigh on the company's earnings going forward. And they also raised some potential concerns about the debt leverage at Kraft Heinz. So that's why we're seeing their shares lower now that they're rated and underperform at Bernstein.
All right, Bloomberg's Monique Malima, thanks for the update. Appreciate that. Coming up, venture capital has long been dominated by just a select few, by who gets in the fund and who gets to invest. There's one woman trying to change that. We're going to talk to her when we come back. Here are the stories we're following in the newsroom today. Home sales jumped in Canada's largest real estate market last month. Sales in Toronto rose by the most in 10 months as lower prices began to lure back buyers. Sales rose by 10% in May from April, the biggest month-to-month increase since last July. Housing markets across Canada, of course, have been slumping, with prices falling 20% on average since 2022. Canadian discount retailer Zellers expanding to Ontario. 2 new locations are planned for Toronto and Windsor. There are plans to nationalize the chain, with talks to open stores in Calgary, Vancouver, and Ottawa. Stores will be stocked with clothing, home goods, luggage, toys, food, and seasonal items. Tracking shares of Macy's today, the high-end retailer reported growth for the first time in almost 4 years. Profit and revenue beat expectations, while same-store sales rose across all of its brands. Macy's also lifted its full-year sales and profit outlook. Some analysts note the results indicate consumers will continue to shop despite rising prices and continued inflation. The TSX down on the day so far, a drop of 169 points, or about 0.5%, holding right now at the 35,000-point mark. A streak of red across the U.S. markets as well. The S&P is down about 0.4%, the Dow down about 0.7%, and the NASDAQ down about 0.7% as well, 176 points down for the NASDAQ. Venture capital funds are typically male-dominated and only accessible to the wealthy. Enter the Women's Equity Lab, created to be run as a democratic fund that gives women complete autonomy over decisions. Let's go to Katie Hirsch. She's managing partner at Women's Equity Lab for more on that. Thanks for joining us today.
Thanks very much for having me.
How long or when did this idea first come about? How long have you been working to help put it together?
So it started in Victoria in 2017 with a group of women there that were seeing a gap in early stage funding for businesses and realizing that there were many experienced professional women that just didn't have sightline into this early stage space. And so they started it in Victoria, and it since has expanded across the country. We've got 8 investment groups now right across the country, coast to coast, going from Victoria all the way over to the Atlantic. I personally joined in 2023, and we are now in our 3rd fund here in Manitoba, our largest fund yet, with 62 limited partners.
All right. So you say it's a democratic system. How so?
Yeah, so really at Well, we like to talk about not only ROI, which of course is incredibly important in looking at these investments, but also in the learning on investment, what we term the LOI. And so we are not just expecting that people are coming on board and writing a check. They're also going to be very active participants in learning a new skill, sourcing deals, doing due diligence on them, making connections with founders, and then ultimately making a collective decision on whether to invest or not. And then moving really into a passive monitoring phase where we watch these companies grow and continue to try and find ways to add value through the expansion of our networks.
Does the fund have a focus? Or are you looking to invest in certain kinds of businesses?
No, we are sector agnostic, Canadian founded, of course. Really, there's a focus on making sure that we participate in and help to grow the Canadian innovation economy. But beyond that, we're looking at businesses that ideally are tech enabled, but across every sector, from health tech to consumer product goods. Of course, AI and the technology explosion that's happening right there is always capturing our attention. But really looking at businesses that have that growth trajectory that makes it an attractive early stage investment. Not by any means a requirement, but there is certainly a focus of looking at businesses that are founded by diverse founder teams. So that could be women founders, mixed gender founders, or anyone that has really a diverse background that typically are not getting their fair shake when engaging with early stage investors.
So, Katie, then what do investors need to know, people who want to invest in the fund?
Really at the Women's Equity Lab, and this goes for right across the entire network, is we are looking to be an accessible fund. So the buy-in is at a price point that most who are interested in this space can make sense of, anywhere from $5,000 to $7,500. But the beauty of it is that you're pooling that capital together, and then you're working as a team really to deploy it. So if you're looking to get involved in building out a new skill set, augmenting your existing professional experiences, looking to build a network of really talented, brilliant women that are similarly committed to participating in this type of a space and being champions for early stage businesses in the country, then this is the fund for you.
And as far as the investment side of it goes, because I'm sure there are always people who need the investment, as far as getting investors, how successful have you been so far? Have you found focusing this way on women and women who can put in even smaller amounts to be a successful way to unlock capital?
There's no question. We are seeing growth in every single one of our regions. And I'll speak to Manitoba. We, like I said, are on our third fund. We just closed Fund 3 with 62 limited partners. That is a jump up from 37 limited partners in our second fund. We opened it up, and within a month, we were entirely subscribed and actually having to turn people away at the end. So this is clearly resonating with women. They understand that this is a really rewarding way to get involved in this space, and that this is the vehicle to do it in. And we're, as I said, we're seeing that right across the entire country. The beautiful thing is that 68% of our limited partners are new to this type of investing. And so when you think of that, these are women that have the capital, they just weren't knowing where to deploy it before. And by getting involved in a space like this, you are building that experience, that muscle that gives you the confidence to look at these early stage investments. And many of them are turning around and then going on to make their own personal investments, either follow-ons in our well companies or beyond. So it's really unlocking capital that previously was sitting on the sidelines.
You mentioned, of course, this is Canadian-centered and women-centered. I'm wondering if foreign investors are a possibility for you at some point, or have you not gone down that road yet?
You know, we looked in the early days about expanding down into the States, but really this is for Canadians and by Canadians. And that's where we're seeing our greatest growth potential. And it certainly dovetails beautifully into the need to find a way to get early stage capital into Canadian founders. All of us are hearing about how important it is to keep Canadian companies in Canada and have them grow, yes, internationally, but do so from home. And so if we can be one of the conduits to accessing early stage capital and encouraging Canadians to really look at home first, then that's where we see a place for Well.
All right, Katie Hirsch, I'm going to leave it there with you, but thanks for joining us. Appreciate it.
Thanks, Marla. I appreciate it.
Coming up, FedEx new spinoff FedEx Freight listed earlier this week. We'll take a look at how that stock has been doing out of the gate. We're back in a moment. Trade talk has been front and center with the Minister Dominic LeBlanc in Washington yesterday. Now, ahead of the meeting, he issued a letter to the U.S. and Mexico calling for a lengthy renewal of the CUSMA agreement. CTV's Abigail Beeman has more.
Minister, what are the goals of this meeting?
The goals of this meeting is to be able to tell you how well it's gone when we finish at 5 o'clock this afternoon.
The Canada-U.S. trade minister and chief negotiator in Washington to talk with the top U.S. trade rep, Jamieson Greer. Dominic LeBlanc issued a letter to the U.S. and Mexico officially stating Canada's recommendation for a 16-year renewal of the Canada-U.S.-Mexico Free Trade Agreement.
We took stock of the work that the Americans want to do with Canada and the work that we're prepared to do over the coming weeks. I remain optimistic about the work that we can do with the Americans.
While a delegation from Manitoba was also here Tuesday, separately meeting with other U.S. trade officials.
There's clearly a path forward. There's clearly an importance for both countries as well to find a solution to this. So, I think we heard clearly some of those irritants were. I think there's a path that we can make these kind of go away as well, though.
The U.S. has made its irritants known. The booze ban, supply management, and the Online Streaming Act high on the list, with one source today quoting frustration from U.S. officials who said dealing with Canada has been a roller coaster.
He seems to go and socialize and come back empty-handed while the Mexicans have been in formal negotiations, eating our lunch for the last 6 months. I am concerned that Mr. LeBlanc goes down at a time when Mark Carney has led us into the only recession in the G7.
The Prime Minister, meanwhile, tried to downplay the idea Mexico is further ahead in talks.
There's a series of issues, technical issues that they have with Mexico, they have with us, which is why there's a bifurcated discussion. So 30 issues or so with us, more than almost 60, I think, with Mexico at current count. And so we're working through a series of those issues.
Mexico has already wrapped up one round of trade talks with the U.S. with 2 more set, leaving many worried about where that leaves Canada ahead of a July 1st deadline. Abigail Beeman, CTV News, Washington.
FedEx Freight listed as its own independent company earlier this week. The idea is it can handle smaller shipments instead of full truckloads and pivot differently. Let's go to Ari Rosa on this, senior equity analyst in transportation equity research at Citi. Thanks for joining us today.
Yes, of course, my pleasure.
What do you think when initially the idea was floated of FedEx Freight spinning off from FedEx? What did you think of the idea and what triggered it?
It's a great question. It was not necessary, to be clear. I think FedEx was actually running their freight business quite well. But what was felt by management, at least, was that they weren't getting the proper value for the FedEx freight segment. And so even if you go back a year ago when this idea was kind of introduced, if you looked at kind of a sum of the parts valuation across the two businesses, you could see that the parcel side of the business, which most people think of as FedEx, right? That's the kind of e-commerce business, the business that delivers packages to your house. Was really trading at kind of a single-digit PE multiple relative to the freight side, which typically carries higher multiples and higher valuations if you look at kind of where the market values some of the peers. So I think management was really doing this as a way to reward shareholders, to unlock some of that value. And frankly, it's been very effective, right? I mean, FedEx stock is up over 80% in the past year. And so clearly the market is responding well.
All right. So the stock is down over 6%. Over the last couple of days since the start of June. How are you interpreting early investor sentiment?
Early on, I wouldn't make too much of it, to be totally honest. Look, there's still quite a bit of opacity on what the financials are going to look like in terms of the two separate companies, how they're going to trade. There's always a little bit of noise when these types of things happen because there are some investors who will own the parcel side of the business, right, what still trades under the ticker FDX, and then who don't want exposure to the freight side, which is FDXF. And so there's going to be a little bit of selling pressure. We're not too worried about it. We're pretty certain that's going to settle out. And ultimately, these things are going to trade, as all stocks do, on kind of the fundamental value of the business. And on that basis, we think there's upside.
All right. So, Ari, what will larger, bigger investors be watching for in the first year of business?
So there's a number of things that FedEx really needs to do here. So one is establish credibility for the separate management team, right? For the new management team, some of whom are known to the street, but some of whom are kind of new entities or new presence in terms of their interactions with investors and with analysts like myself. And so establishing credibility is going to be important. And then really what we want to see, which is what we want to see from all our companies, is really that earnings ramp. So the company has had an investor day already in the first half of the year. They set out some targets. Frankly, as we look at those targets, we think they're conservative. So we're looking for them to establish that base level of profitability, demonstrate that they can operate on their own as an independent entity, and then show that they can have a path towards growing their operating earnings, growing EPS as a standalone entity. And inevitably, with these types of spins, there are some outstanding questions, right? So what are the corporate overhead costs? How much customer attrition might happen as a result of separating out the business? And to what extent was the freight side maybe benefiting from its relationship with larger parent FedEx, or to what extent was it kind of held back? And so those are the questions that investors are really going to have to grapple with. Management has tried to reassure us that there's a lot of opportunity ahead. We tend to be in the more optimistic camp on that, but there's still a lot of uncertainties. And so we're really kind of eager to see how it plays out. But again, it looks so far at least like a story with a lot of potential.
Wondering, though, with where we are and fuel prices spiking, unsure when the Strait of Hormuz is going to reopen up and how much more that's going to cost to move things around. Does that add a different layer of difficulty in launching right now?
So it certainly adds uncertainty, right? Because we've seen a lot of questions around consumer sentiment, right? Consumers obviously are a little bit jittery about the higher fuel prices. But if you look at a lot of other metrics, I mean, the economy seems to be kind of powering through a lot of those issues. And so ISM Manufacturing Index is kind of posting some of its best levels that we've seen in years. We're seeing a pickup in freight shipments. In fact, FedEx Freight's some of their competitors, Old Dominion and Saia, in the last 2 days have given mid-quarter updates that are actually pretty encouraging in terms of where freight volumes are headed. And then on top of that, we've been in this kind of 3-year freight recession. And so no doubt FedEx Freight has seen some of its operating metrics and some of its financials under pressure. But a lot of that pressure is easing, and that's aided by this kind of tightening capacity on the trucking side. And so we think, again, despite a lot of the macro uncertainty, look, to some extent, right, there's always macro uncertainty. It's the nature of our job. But right now, actually, the setup from a macro standpoint looks actually pretty favorable.
Okay. Any concerns for you when you factor in the North American Free Trade Agreement, or CUSMA, we call it here, that is up for review and could be affecting more transportation the way it has rails, for example?
So it's an interesting question. Across our coverage, there's definitely some concerns, right? So we cover the Canadian rails as well. We cover TFI International, which is based in Canada. Definitely, there are some concerns there. We happen to be in the camp that believes a more benign resolution is likely. It really, frankly, doesn't make sense for the U.S. and Canada to have a deeply contentious relationship in our perspective. And so even though there's a lot of chirping back and forth, we think ultimately a benign resolution is most likely. As it relates to FedEx specifically, look, FedEx Freight operates mostly in the United States, so it's not really too much of a concern in terms of that cross-border issue. FedEx obviously does have some exposure to Canada, but it's one of many countries that it operates in. And so for FedEx specifically, it's not such a big concern. But as we look across kind of our transportation coverage, definitely it's something that we're aware of, but we tend to be a little bit more in the optimistic camp.
All right. Ari Rosa, thanks for joining us. Appreciate your time.
Thank you. My pleasure.
Coming up, we'll hear from a former advisor to Justin Trudeau about the state of CUSMA negotiations. Back in a moment. Trade Minister Dominic LeBlanc met with U.S. Trade Representative Jameson Greer yesterday in Washington. On what was discussed, we spoke with Diamond Issenger. She's former special advisor to Prime Minister Trudeau on Canada-U.S. relations.
The government has made very clear all along to the U.S. administration that they're eager and willing to have any conversation at any time that the U.S. is game. And that's what they did yesterday in anticipation of additional follow-ups that will need to happen over the coming weeks ahead of this, long anticipated July 1st deadline, however firm that ends up being.
And what do you think of his call, LeBlanc, that we should have a 16-year deal? We'd like to see it go 16 years. Who's that playing to?
Yeah, it's consistent with the commentary that the government of Canada has made all along, which is that CUSMA serves the three countries very well. It is helpful for business and investment stability to have a renewed agreement for the long term, not to get into some sort of annualized cycle, for example, of reconsideration of this agreement. And it plays to, I think, increasing some urgency on the United States to take some action here, with them being the partner that we are most waiting for the willingness to sit down and have proper conversations with, and also to stakeholders across the continent, including business leaders who can hopefully exert some additional pressure on the U.S. administration that will resonate far more than the government of Canada saying that same thing.
And with the meeting, should we take something from the fact they got together? I mean, we heard Trump afterwards calling 51st state again. But should we take something of the fact they actually did sit down?
Yeah, absolutely. It's very positive that they had that opportunity to interact while brief. It's a little bit awkward, of course, because the U.S. trade representative was heading off on a trip internationally that I believe he left for last night or early this morning. He's going to encounter in that trip abroad another Canadian, our trade minister, Maninder Sidhu. Perhaps they'll have the opportunity to have some brief conversations on the margins of some international meetings. But it's always positive when we can have those conversations face to face in the room together, particularly because the bluster or the rhetoric or jokes about annexation on Truth Social, for example, are actually the outlier here. Most positive is when Canada and the U.S. can have working level constructive conversations face to face, relate our interests to each other, figure out some common ground and ways to move forward, away from media and social media.
It's been kind of nice. We haven't heard that comment in a while, so that part's been nice. Now, of course, there's negotiations going on with Mexico as well. Are we in this oh my goodness, it's almost like we're dating the U.S.? They're talking to Mexico more than they're talking to us. Should we be worried?
Oh, in that metaphor, I'm not so sure. I mean, back in 2017, back in 2017 and 2018, this was also the case, actually. We had very formal trilateral renegotiation talks going on in these rounds that took place throughout North America over the course of about 18 months. But at different points, there were actually bilateral conversations that did happen separately between all of the parties, but including the U.S. and Mexico. Those at times seem to be operating on a different track, perhaps faster or with more progress. I don't take that as a deal breaker, though, for the possibility of getting to this renewed CUSMA with the three countries involved, because Mexico and the U.S., as the Prime Minister has said, as many commentators would observe, they have their own unique issues. There are many issues, including, as you may ask about in this conversation, last night's new forced labor tariffs that came out from the United States. We have very different labor realities, for example, in Canada versus Mexico, very different workforce realities, very different dominant industries. And so I think it makes sense for Mexico and the U.S. to have those conversations, but with the goal of getting to the table, all three together very shortly for a formalized review.
And I wanted to get your thoughts actually on that we're actually facing that tariff, the forced labor tariff. Is that just a play or is it legitimate?
I mean, forced labor is not an issue in the sense that it's important that countries take action. Canada has previously had legislation that was introduced and passed to take action in this regard. I understand from your coverage, the Prime Minister has just made some comments indicating that Canada is willing and able to take additional action. But really, this is yet another endeavor by the U.S. administration, and particularly the President and the U.S. trade rep, to essentially replace the tariff regime that was in large part struck down by the Supreme Court with a patchwork of other tariff possible avenues to see what is durable. They were told essentially that their prior approach was not legal and that they couldn't proceed in that way. And so we've seen a number of other tariff issues come forward in recent days and weeks as they try to replace that with this new set of options.
All right, last question. We're almost out of time, but July 1st, carved in stone?
No, absolutely not. If you had asked that question a few months ago, perhaps the answer might have been different. We have this deadline that actually is from the agreement itself. It makes reference to July 1st. It's not a deadline that media or stakeholders or government made up independently. It has existed all along. But the urgency of actually resolving this issue by that date versus instead making progress and signaling our clear intentions, that is the piece that has shifted. I think it does provide some useful pressure, though, as if there wasn't already enough just inherent economic pressure for the three countries to come to the table to have those conversations. But I think the real time pressure this year is really going to be in and around the U.S. midterms as the U.S. administration continues to feel pressure under the rise in cost of living, of goods across the United States, job losses, et cetera, that are influenced by tariff pressures, and hopefully getting to a solution.
Diamond Eisinger is a former special advisor to Prime Minister Trudeau on Canada-U.S. relations. Let's have a last look at the markets before the end of the show. We have the S&P down 39 points, or 0.5%. The Dow Jones also down 0.9%, and then the Nasdaq dropping 0.75%, or a 200-point drop so far on the day. And the TSX, which hit a record close yesterday, now under 35,000 points. So it's down 183 points, 0.5%, to 34,985 at this hour. Getting to a couple of the big movers for Toronto. Advantage Energy, a gainer today. It's up 4.7%, so it's a lift of 47 cents per share, taking the share price to $10.46. And it is down a little over, almost 7% on the year. Advantage Energy was there. Let's go to Abra Silver, which is moving the opposite direction, down almost 9%, or $1.66 loss per share, taking the share price to $16.85. Take a look at the 1 year. It's up over 300% in the last year. And join us today, 3 p.m. Eastern, for Know Your Options. That is with Chris Tom of Moat Financial. Send in your options trading questions to knowyouroptions@bnnbloomberg.ca. And Market Call is coming up next. We have David Burrows with us on the show, Chairman CEO of Barometer Capital Management, taking your questions on North American large caps. Thanks for joining us today on Morning Markets. I've got Market Call coming up next. Stay tuned.